Hey everyone, welcome back to Corporate Decoder, the place where we break down big company secrets. And let's just say this latest report from Aimfinity Investment Corp. I had some interesting numbers that look like a roller coaster ride. Before we dive in, if you like getting the real story behind these filings without all the jargon, make sure you are subscribed. And hey, if you want to chat more about these companies and get exclusive insights, join our Discord community. The link is in the description below. Alright, let's get into it. We're looking at Aimfinity Investment Corp's quarterly report for the period ending the 30th of September 2025. Think of this like a financial checkup for the company. What is really important here are the financial statements, which give us a snapshot of their money situation. First up, the balance sheet. This shows what the company owns and what it owes at a specific point in time, looking at the 30th of September 2025. Their total assets are about $14.3 million. Now compare that to the 31st of December 2024, where it was over $36.9 million. That is a big drop in total assets. A significant chunk of this is the cash and investments held in their trust account. It went from over $36.9 million down to just over $14.2 million. This is a pretty stark decrease, suggesting a lot of that money has been used up or returned. On the other side, we have liabilities and shareholders' deficit. Their total liabilities are around $5.6 million as of the 30th of September 2025, down slightly from about $6.1 million at the end of 2024. What stands out is the ordinary shares subject to possible redemption. This is a huge number. As of the 30th of September 2025, it is about $14.3 million. And at the end of 2024, it was almost $37 million. This represents shares that shareholders can redeem for cash, and seeing this number drop so dramatically reinforces that a lot of money has been paid out to shareholders. Now let's look at how they've been performing. The statement of operations shows their income and expenses. For the 9 months ended the 30th of September 2025, they reported a net income of about $117,000. This is pretty low, but the year before, for the same period in 2024, they actually had a net income of over $902,000. So their profitability has taken a significant hit. Where is this income coming from? A lot of it is interest earned on cash and investments held in their trust account. For the 9 months ended the 30th of September 2025, that was over $630,000. For the same period in 2024, it was a much larger $1.6 million. So their earnings from their investments are also shrinking, which makes sense with the much lower balances in the trust account. Offsetting this income are their formation and operating costs. For the 9 months ended the 30th of September 2025, these costs were over $512,000. A year prior, they were higher at over $700,000. While costs have slightly decreased, their income from investments has decreased much more significantly, leading to that lower net income. The statement of changes in shareholders' deficit tells us how the owner's equity changed. This is where things get a bit complex with SPACs or special purpose acquisition companies like Aimfinity. Notice the additional paid in capital, which is positive at nearly $1.5 million in September 2025, but was zero at the end of 2024. This likely comes from issuing Class A ordinary shares in exchange for loans. However, the accumulated deficit is significant. As of the 30th of September 2025, it is a deficit of over $7.1 million. This means the company has lost more money than it has made over its lifetime, which is common for companies in their early stages or going through major transitions. The total shareholders' deficit is negative, meaning the company owes more than its assets are worth from the shareholders' perspective. The numbers here show a growing deficit from over $6 million at the end of 2024 to over $7.1 million by September 25. The cash flow statement is crucial. It shows how cash moved in and out of the company. For the 9 months ended the 30th of September 2025, their net cash used in operating activities was nearly $366,000. This means their day-to-day operations are costing them more cash than they're bringing in. This is typical for a company that isn't generating revenue from products or services yet. Where did the cash come from or go? Investing activities show a huge swing. In the 9 months of 2025, they had net cash provided by investing activities of over $23.2 million. This is a massive inflow. It largely comes from withdrawing cash and investments held in the trust account, which is directly related to shareholders redeeming their shares. In contrast, for the same period in 2024, they had a similar large inflow of over $9 million from this activity. Then we look at financing activities for the 9 months of 2025. Net cash used in financing activities was a whopping $22.9 million. This is primarily driven by ordinary share redemptions, which again means they paid out a lot of cash to shareholders who wanted their money back. This is a direct consequence of the trust account money being withdrawn. This line item, ordinary shares subject to possible redemption, is super important for SPACs. It represents shares that public shareholders can choose to redeem for cash. The numbers here are dramatic. As of the 31st of December 2024, there were over 3.1 million shares subject to redemption valued at over $36.9 million. By the 30th of September 2025, this number has shrunk to just over 1.1 million shares, valued at about $14.3 million. This massive reduction clearly indicates that a huge number of shareholders have decided to redeem their shares, cashing out their investment. This is a critical indicator of the company's current status, suggesting a major event has occurred or is about to occur, leading shareholders to seek their money back. Looking at the statements of changes in shareholders' deficit, we see line items like extension funds attributable to ordinary shares subject to redemption. In the 9 months ended the 30th of September 2025, this shows a cost of over $502,000 related to these extensions. In 2024, it was a larger $615,000. This points to the company taking steps to extend its deadline to complete a business combination, which often involves the sponsor or related parties putting in more funds or guaranteeing more funds to keep the SPAC alive. Another key figure here is the accretion of carrying value to redemption value. This is an accounting adjustment that reflects the difference between the initial value of the redeemable shares and their value at redemption. For the 9 months ended the 30th of September 2025, this adjustment cost the company over $1.1 million. In the same period of 2024, it was over $2.2 million. This accretion essentially represents the cost of keeping those redeemable shares on the books as the redemption date gets closer, and it eats into the company's equity. Then we see issuance of Class A ordinary shares upon conversion of working capital loan related party, an extension loan. Related party, this shows that in the 9 months of 2025, the company issued about $1.5 million worth of shares in exchange for converting loans from related parties. This is a way to pay off debt without using cash, but it does dilute existing shareholders. The going concern consideration section is always a red flag. Management states that as of the 30th of September 2025, the company had only about $3,500 in cash and a working capital deficit. They explicitly say these conditions raise substantial doubt about the company's ability to continue as a going concern. This means there is a real risk the company might not be able to operate for the next year unless it can complete its business combination or secure more funding. If they don't complete a business combination by their deadline, they will likely liquidate. The financial statements themselves do not include any adjustments for this uncertainty, meaning they are prepared assuming the company will continue operating. The report also talks a lot about a business combination with Dr. Inc. This is clearly the main event they are working towards. They've entered into a merger agreement and there have been several amendments. This indicates a lot of back and forth and potential challenges in getting this deal finalized. The terms of the deal involve converting existing Aimfinity shares into Doctor shares, and there are earnout provisions tied to Doctor's future sales performance, which is pretty standard for these kinds of deals. The company has also been extending its deadline to complete this business combination multiple times. This is evident in the extension section detailing how they've had to deposit funds into their trust account to buy themselves more time. They've gone through several extraordinary general meetings, or EGMs, to get shareholder approval for these extensions. Each extension comes with a cost, either through deposits into the trust account or by issuing promissory notes, which are essentially loans that can be converted into equity. This constant need for extensions signals that finding and finalizing a suitable business combination has been a difficult and drawn-out process. What is interesting here is the discharge agreements mentioned on the 13th of June 2025. This is about the deferred underwriting commission. Normally, the underwriters get paid a chunk of money when the IPO happens, and another part is deferred until a business combination here. They've agreed to take a smaller cash payment and a certain number of Pubco ordinary shares instead of the full deferred commission. This could be a sign that Aimfinity is trying to conserve cash, or that the underwriters are willing to take on more risk as equity in the combined company. The underwriters agreement details how the underwriters get paid. They received a cash discount at the IPO and a deferred fee of about $2.8 million. This deferred fee is paid out only if the company completes a business combination. The agreement's on the 13th of June 2025. show they are now accepting shares instead of cash for a portion of that deferred fee, which is a notable change in how they are being compensated. The trust account, holding over $14.2 million in US Treasury securities, is the core of Aimfinity's operations. This money is set aside for the business combination. However, the fact that it has dropped so dramatically from nearly $37 million at the end of 2024 means a lot of shareholders have decided to take their money and run. So, what does all this mean? Aimfinity is in a very precarious position. Their cash reserves are dwindling. The majority of their initial capital has been redeemed by shareholders, and they are heavily reliant on completing a business combination with Dr. Inc. The substantial doubt about their ability to continue as a going concern is a major warning sign. They've had to extend their deadline multiple times, suggesting challenges in closing the deal. The significant drop in the trust account balance points to a lack of confidence from investors in the company's ability to execute its strategy or find a suitable target, while they are pushing forward with the Doctor merger. The financial numbers tell a story of high cash burn and significant shareholder exits. It is a race against time to finalize the merger and hopefully turn things around for the company and its remaining shareholders. Alright, that is our breakdown of Aimfinity Investment Corp. As latest filing, what is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. And don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.